silver. I'm not going to speculate as to what their thinking might be. But at the end of the day, you can't resist a bull market in anything. When you see something going up, you might ignore it for a bit, but then there comes a point where you can ignore it no more, and you've got to go and buy some. We have yet to see that. And it's perfectly capable of taking silver. Well, I mean, we're approaching 60 as we are. I mean, spot is 58.3. 60 is a doddle this week, easily. I mean, that's not a forecast, but I wouldn't be surprised. 70, 80, 90, 100. I mean, this is equally possible.
Yeah.
Let's take the first one.
Gold and silver are signaling an imminent fiat currency crisis. Gold's rise past $4,200 reflects dollar collapse, while silver faces a global supply squeeze approaching $60 with potential for $100 plus. Despite this, investors remain absent from precious metals markets. The warning, rising bond yields will burst the equity bubble, forcing massive Fed intervention that accelerates currency debasement. Both metals indicate 2026 inflation expectations are catastrophically wrong, with an insolvent Fed guaranteeing major monetary destruction ahead. Thanks for watching. Subscribe to Fine Metals for more updates.
The other thing, of course, and I'm going over to gold, which we need to move on to, is that what gold is telling us is that the whole fiat currency system is getting into deep trouble. What that means is, sorry, I interrupted you.
No, I was just going to say I have the gold chart up, but yeah, continue. Go ahead.
Yeah, I mean, the point to understand is that over long periods of time, the purchasing power of gold is stable. I mean, things change and so on and so forth, but it's been the case really going all the way back in history. I mean, the thing about gold is that the above ground stocks have tended to increase more or less in line with the global human population. I mean, we've got records that go back, quite a lot of it estimates, but, sort of, sensible estimates. And we can see that relationship. And not only that, it is embodied in all our laws that it is real money, final settlement, expunging all counterparty risk. That's the important point. And it doesn't matter what the US Treasury says, whether it's a pet rock or whatever. I mean, they're just promoting their own fiat currency instead. But the fact of the matter is that in everyone's common law, gold is money, and it is a stable form of money, and has been and will continue to be through millennia. So when we see the gold price rise in 1971 from $35 to currently $4,234 as we speak, I mean, that's not gold rising, that's the dollar declining. The idea that you can measure the dollar's decline by looking at consumer price index and all the rest of it, well, that gets fiddled, as we know. They think that inflation is becoming less of a problem in 2026. They think the purchasing power of the dollar, it might drift back towards the 2% target, but basically they don't see it going up. What gold is telling us is no, that's wrong. The purchasing power of the dollar is going to decline, which put another way means the consumer price index is going to start rising, and probably quite sharply. And we can see that. Now, the reason that the consumer price index will start rising is because the purchasing power of the dollar will be declining. This is going to rise and rise and rise. But that is what the outcome is. That is what gold is now telling us. Well, I think that's all you need to know. This is a squeeze on the system. China has gone out of the market completely. I mean, you can't arbitrage silver from China to sort out our markets, and that is if they were prepared to do it anyway. The squeeze is also in China. I think it's a global squeeze, and it's the result of over 5, 6, maybe 6 years of supply shortage relative to demand, and demand is just going off the scale with photovoltaic cells and all the rest of it. So silver it's being driven, if you like, by industrial means. there will come a point when the investment community wakes up and decides we better have some, actually the last one you mentioned, the spot price rising more than the futures price. I think that's just showing, if you like, that the squeeze is on. The squeeze is pushing up the spot, and the futures price is either following or it'll go into backwardation, whatever. I mean, the two things aren't directly related. You're not getting the arbitrage, Danny, whereby someone sort of looks at, lease rates and all the rest of it, and, premiums and things, we can trade this. They're not doing it because there isn't the liquidity to do it. Because, if you're going to sell silver into, in order to do an arbitrage, whether you do it out of futures or out of London, you've got to get the stuff back. So people, I don't think, are really playing these small nuances. In town, we got to go for it. We go and buy this one, buy that. They're not doing that. They are totally absent. And the result is that the prices are being marked up or down, more or less on yesterday's performance, if you like.
So there's a lag involved when it comes to the mining stocks.
I think there's a bit of a lag. And I mean, basically, if you are beginning to get, the price of, let's take an index of silver stocks. If they really started to move ahead of the game, then quite clearly it would be the investment community saying, when we start talking mines, average investor he's clueless. He's got no idea. And he doesn't want to know, really. I mean, it's just too difficult. Just give me the things I understand, he says, I think. I think that's why you've got this sort of extraordinary situation where the response from silver mines and, encapsulated in the indices, and also for gold as well, and other mines in general, is just a complete disinterest from portfolio managers. Yeah, I mean, they've had commodities educated us.
But what about SIL and SILJ? You would think that the mining stocks would be outperforming the physical metal in this kind of scenario, but that's not. They're pretty much even here, but yeah. I think
the answer to that. I mean, I've been watching in London. We've got the largest silver mine in the world, actually, Fresnillo, listed on the London Stock Exchange. And it's been interesting to see how that performs relative to the silver price. It doesn't run ahead of the silver price. It's behind the silver price most of the time. And it maybe catches up a bit the next day. The idea that correlates quite well with the silver price, the idea that investors looking to buy or sell Fresnillo, SLB, or whatever it might be, are actually sort of bullish on silver. No, they're not. I mean, the prices are being dragged up by the physical market, not by investor interest saying silver's the game. Shorted, not shorted, but borrow some stock, submit that to the trustees of SLB and say, come on, we want 100,000 ounces, whatever the equivalent is. There are those games going on, which is one reason why I'm not at all keen on having ETFs. I mean, if you're an investor and you can't think otherwise, then go and play in the ETF markets. But if you come a cropper, I mean, just bear in mind, you're not buying physical metal. You're buying a piece of paper, which is a derivative of it. No more than any other derivative. I mean, if derivatives are in danger, then I would suggest that ETFs are not necessarily the best way to play this market. We are losing confidence in credit. Now, I know many economists, most economists perhaps, think that currency isn't credit, but oh yes, it is. It appears on the central bank's balance sheet as a liability. It is credit. It is the liability of the central bank. And we know that most of these central banks, including the Fed, by the way, have obligations greater than their the assets to back them in terms of value. They just don't choose not to mark things mark to market. Basically, if the Fed was a private sector industry, the directors would be in jail now because they'd be trading well bust, effectively. We know what the situation is. We can see how the debt is racking up even further. And when that happens, bond yields rise. And as bond yields rise, what happens to equities? The equity bubble goes pop.
Yep.
And when the equity bubble goes pop, then what does the Fed, what does the US Treasury do? It rescues everything it possibly can, because that is the mandate. In other words, what we're going to see, what gold is telling us, is that the conditions that are evolving now are guaranteed to lead to the debasement of the currency, of the fiat currency, big time. So everybody's expectations that inflation is not going to be a problem in 2026 is so far wide of the mark. And I don't know of anyone who's looking at inflation in 2026 and saying the best indicator that you can possibly have, not perfect, is what is the exchange rate between dollars and gold. Now, the interesting thing, Danny, is that when you look at expectations, if you like, amongst economists and also portfolio managers, silver is in a bull market. We got to buy these mines. Yeah, they're not doing that. Honestly, they're not bullish. You and I and others, if you like, who've been following gold and silver for some considerable time, could express our views by saying we're bullish of gold, we're bullish of silver. And I've just explained why the market is short, et cetera, and that's going to drive the price higher. But the investment community as a whole is just not interested. They don't understand it. They would rather chase the Nvidias and the tech stocks of this world. And apart from anything else, a commodity is not a regulated investment, and therefore it's verboten. Don't go there, mate. The one thing I've noticed when it comes to stocks, which is what SLV is, if you like, is that the price isn't necessarily tied directly to the commodity. And what we could be seeing, and I don't know that this is the case, but what we could be seeing is that the prices may be held back a little bit as authorized participants decide to borrow some stock